Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, welcome to This Explainer. Today we're unpacking Southwest Airlines' massive operational and financial transformation. We'll be objectively analyzing exactly how they navigated some severe fleet delays, executed an unprecedented internal restructuring, and successfully overhauled a 53-year legacy model to hit record profitability in early 2026. Here's our roadmap for the breakdown. First, the state of the market. Then, we'll look at how they navigated Boeing's MAX delays, followed by the 2025 corporate restructuring. After that, we'll cover transforming the passenger experience, and finally, that massive Q1 2026 financial rebound. Section 1, State of the Market, a domestic giant. To really grasp the scale of this turnaround, we first have to look at just how fiercely competitive this space actually is. Looking at the data between June 2025 and May 2026, Southwest held a massive 17% of the domestic market share. That puts them literally neck and neck with legacy giants like Delta at 17.9%, American at 17.6%, and tied exactly with United. So they aren't some scrappy underdog here. They are an absolute cornerstone of U.S. aviation. And that market share? Well, it translates to over 140 million passengers recently. 140 million. When you're operating at that sheer volume, every single operational hiccup is magnified. It makes the headwinds they were about to face all the more impactful, not just for them, but for the broader travel economy. Section 2. Navigating Boeing's MAX delays. The friction. Now, here's where the friction really starts. Southwest's heavy reliance on Boeing created a massive roadblock for their modernization plans. Originally, they expected the Boeing 737 MAX 7 to be ready to go back in 2022. But thanks to persistent engine anti-ice complications, which Boeing only just finished redesigning in the summer of 2025, FAA certification isn't even expected until August 2026. This means Southwest won't actually fly the MAX 7 commercially until at least the first quarter of 2027. That's more than 4 years late. And this isn't just some minor delivery delay. Because Southwest is the launch customer, they hold roughly 90% of all MAX 7 orders. This huge backlog effectively forced them to keep flying their older, way less efficient 737 NG fleet much longer than they ever planned. Yeah, they managed to get 50 MAX deliveries in 2025, but they still have over 310 active 737-700s they're trying to slowly phase out. The reality is, operating older planes burns more fuel and cranks up maintenance costs, which heavily squeezes those operating margins. Moving to Section 3, the 2025 corporate restructuring, hard choices. Faced with these relentless delays and climbing external costs, management had to initiate some absolutely unprecedented internal changes just to survive. In February 2025, Southwest executed a highly uncharacteristic 15% workforce reduction. Now, it's important to note this was focused almost entirely on corporate overhead and leadership. They eliminated 1,750 corporate roles and 11 senior leadership positions, which, by the way, wiped out 15% of their senior management committee in one swoop. CEO Bob Jordan addressed this directly, stating, "This decision is unprecedented in our 53-year history, and change requires that we make difficult decisions." This wasn't just your standard corporate trim. This was a fundamental shift. They needed to create a leaner, much more agile organization that could actually absorb the shocks of those Boeing delays and rising fuel prices. When you look at the balance sheet, the math behind this restructuring is really compelling. Despite taking an expected one-time severance and benefits hit of up to $80 million early in 2025, this aggressive move was projected to yield $210 million in partial year savings. And that ramps up to a massive $300 million in full-year savings for 2026, building a crucial financial buffer. Section 4. Transforming the passenger experience. A new era. But here's the thing, simply slashing costs was never going to be enough. Southwest had to fundamentally overhaul its legacy business model to unlock new passenger revenue. For decades, Southwest was synonymous with open seating. You know the drill, no assigned seats, just line up and grab whatever you can.
But in early 2026, they completely dropped that 53-year-old policy, rolling out assigned seating and extra legroom. Plus, they started ripping out that basic Wi-Fi with no power, replacing it with Starlink ultra-fast Wi-Fi, larger overhead bins, and that all-important in-seat power. To evaluate if this massive strategic pivot actually worked, we have to look at a metric called customer buy-up. Basically, this measures the percentage of passengers who choose to pay a premium out of their own pocket to upgrade from the base fare to higher-tier options. It tells us exactly how much the market values these new perks. And the market's response? It was overwhelmingly positive. Right after the January 2026 launch of assigned and extra legroom seating, premium upgrades literally tripled year over year. A staggering 60% of customers chose to upgrade from the base product in Q1 2026, up from just 20% the year prior. On top of that, Rapid Rewards loyalty enrollments spiked 37%. People weren't just accepting this new era, they were actively paying for it. Which brings us to Section 5. Q1 2026 Financial Rebound. The result. All those painful internal cuts and bold product changes translated into an incredible turnaround story by the first quarter of 2026. Just look at these numbers. They completely flipped a negative 3.5% operating margin into a positive 4.6%. They reversed a painful $149 million net loss into a robust $227 million net income. Overall operating revenues hit a first quarter record of $7.2 billion. That's a 12.8% increase year over year. And it wasn't just everyday leisure travelers paying for extra legroom that drove this. Corporate clients came back in a massive way. Managed business revenue actually delivered its strongest March and quarterly performances in the company's entire history, jumping 25% and 16% year over year. This surge was absolutely vital because it completely offset the severe headwinds of higher fuel costs, which had climbed to $2.73 per gallon during the quarter. Looking ahead through the rest of 2026, Southwest is keeping a tight grip on capacity. They're expecting 66 Boeing 737-8 deliveries, allowing them to finally retire about 60 older, less efficient planes. They're managing a disciplined $3 billion to $3.5 billion in net capital spending. And honestly, they aren't afraid to cut their losses anymore, aggressively pulling resources from underperforming markets, like suspending operations entirely at Chicago O'Hare and Washington Dulles. So while the financial rebound in Q1 2026 is undeniable, as objective analysts, we always have to look to the horizon. The airline completely rewrote its 53-year legacy and unlocked massive new revenue streams, but they still don't have those MAX 7s they so desperately need. So the real question is, can this new, premium-focused era provide enough of a financial runway to weather the continuing storm of aircraft delivery delays? Which side of the trade are you on? Do your own homework, dig into the filings, and we'll see you next time on The Explainer.